So good morning. YouTube wasn't loading for me. All right, good morning. Welcome to Forex.Today. YouTube community of more than 20,000 foreign exchange traders. We gather here today to conduct technical and fundamental analysis with the overriding goal of planning our trades in advance. Let me remind you that trading is risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. Please stay small, stay humble, focus on the long term, never risk money you cannot afford to lose. My name is Wayne. I'm a foreign exchange trader like you. I started about 20 years ago messing around with this thing we call Forex. Yep, very cool. And I wasn't very good in the beginning, but I got better. Cool. So anyways, I'm willing to share. People ask for resources. They're like, hey, Wayne, will you start a community? Yeah, fxbootcamp.com. The link is in the description below. Will you write a book? Yeah, Strategic and Tactical Forex Trading. The link is in the description below. Wayne, will you do training videos? Yes, there's 88 hours of training videos at fxbootcamp.com. It's only $88 a year. Yeah. And they're not just, like babble fests. No, they're like college lectures. Not even joking. You're going to be blown away. I would say at least $1,000 worth of value for $88. Go check them out. What else? People are like, Wayne, what broker should I use? I want a trustworthy, ethical foreign exchange broker with fast execution speeds, narrow spreads, and huge swaps. Wayne, can you point me in the right direction? Yes, tradersway.com. The link is in the description below. Wayne, can you help me with macroeconomic analysis? I don't know, like GDP in this country versus GDP in that country, but there's also inflation, there's employment, there's interest rates level, there's seasonality, there's commitment of traders report data, there's retail positioning. Like, oh my God, Wayne, can you help me with all that? Yes, that's quantbox.co. The link is in the description below. Oh my God, whether it's fundamental or technical analysis, trader psychology, or an excellent service provider to your small, successful Forex trading business, all those resources are available in the description of today's video. Make sure you click a thumbs up and like while you're at it. Would that be nice? Would that be okay? Taking a look at around the world, we can see dollar just trying to pick up now off of our support line, which we've been here for going on over a month on our line. Okay. Taking a look at yen, little bit of stabilization. Okay, a little bit of stabilization. This is longer term, by the way. So this might not reflect last night, but in general, right? So these are indices built on daily candles. Swissie is actually, strong to flat. Okay, CAD, as you can see, trying to rebound. It hasn't quite made a higher high on its index. Remember, this is CAD versus everything. And so it's trying, and it's been strong the last few days. And, well, maybe it'll make a higher high. We don't know yet. But Kiwi and Aussie are also on the move, and all of that is risk on. Now, today is poised to be risk off, so we'll see which one wins. But Aussie up, Kiwi up, CAD up is all risk on. Okay. Pound is strong because the Bank of England is going to have to come in and do a lot. They are behind the curve. Hey, Jermaine. No, do I use smart money concept? No. Probably been trading too long. So, right? Concepts and methods are not something I do. All right. So anyways, and so based on the likely central banking policy of Great Britain, boom, 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 there's some money flowing that way to catch the rate of change. So think of it this way. The Fed might be slowing down its rate of change in interest rates, and Great Britain will probably have to speed up its rate of change, and therefore money is being attracted to that. Cool. Right on. We'll take a look at exotics quickly. Okay, you see it's made that other leg down. And now you might want to start looking in this zone. This is the zone. I'll never buy peso again. I guess, well, you're shorting this. So anyways, so you want to take a look at that. And if that heads back down today, that's risk on. Taking a look at commodities. Okay, gold. If I zoom in here, gold. Hit our target today, day traders. Day traders. Talking about day traders. Right? So anyways, last night's trade plan was this way. And then that should move into a bigger trade based on the 4H if we can now get above that risk level. Okay. Okay, anywho, so now we've hit that daily target. Can we hold it? Well, that is also a risk on move if that's heading up. But that was our trade plan last night. Good. I guess we should do my WTI. Let's zoom in here with okay, and still no lift off on WTI. But if you're a bull, you're gonna try this. Today is gonna be the day. Okay. By now, you should have somehow realized what you got to do. So that's all bullish. So you need Bitcoin up today. And Bitcoin's in a support zone, so that could actually happen. So one of the things we were talking about just yesterday, right? Remember, I have this. And this is a zone, right? That's a zone in which it's up, and if oil's up, you want the stock market up, you want the US dollar down, you want Aussie, Kiwi, and CAD up. Okay, so that's why you go through this methodology. But right now, it's not really a bullish day in the S&P 500 futures pit. We are below the moving average, and we are making a series of lower highs and lower lows. That's risk off, baby. Okay, that's risk off. And well, everything else is trying to head up, but that's down, right? By now, you should have somehow realized what you got to do. I don't believe that anybody trades the way you do. All right. So that says risk on. Top of the range, though, huh? Top of the range to ya. Okay. Top of the range, you might want to say, well, we need a little more info. So we could do, what do you want to do? Well, if it's risk on today, we want bullish. And so down to the 21, give that a try. What do you think? Smell like a plant? Boo, 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 boo. Boo, 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 boo. Boo, 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 boo. Boo, boo, do, 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 do. Do, 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 do. Okay. What do you think if that's a continuation? No, Luis, it doesn't sound like a plan. It smells like a plan. I say, what do you stink? And you're like, smells like a plan. German says, that's what SMC. So what I just did is the SMC model. Great. Well, I've been around longer than them, so they're copying me. Cool. Hey, Wayne, saw you do earlier. Yeah. Do I want to look at ZAR? Well, the thing is, you have to pick the risk on or risk off, and we're sort of neutral in that right now. So, no, not yet, Descartes. Not yet. I haven't, right? No. Not quite yet. I'm going to go CAD before I go RAND. So I got to figure this out, Descartes, before you start going into other exotics. Okay. What we want to see is if this is risk off, stock market down today, but it could do that, okay? And that's stock market up. So I'm not quite there yet. So the blue line is kind of like what the stock market is saying today. Now that just might be pre-market. But if the stock market is down today, then I don't want to do the RAND, so I don't want to look at it. See, I'm worried, Descartes, that I open that pair and I see a trade. But I don't trade that way. I start the other way around. Right? So I don't want to open up that trade unless I'm ready to pull the trigger. But I'm not ready to pull the trigger, so I don't even want to look at it, because my fear is I'll find a good technical trade that, well, fundamentally might make no sense. Okay. Okay. Oh, you bought what? Oh, this? Or don't tell me you bought USD Rand. No, yeah. Well, yeah, so look, guys, these are, this is annual, right? So this is pretty easy trades, right? Every boot camper knows how to make these trades. So you have this trade that lasts for the end of the year, okay? And you have this trade, oops, that was supposed to be a different color, but then you have that trade that lasts till the end of the year, and that's all there is. And what I keep trying to show you is you guys get so involved in these little tiny movements, all in here, right? Day in and day out, you're getting involved in this, and every day, you make 25, you lose 25, and then you start over, and the next day you make 25 or you lose 25. And that's okay if you're trading inside of a context of, like, if you are in this area as a bear, then the only thing you sell the only thing you do is sell. Okay? And so you might have sold, out. Maybe you're selling again. But you're there. And if you do catch a move like this, you have the fortitude to stay short. That's all. But these are annual pivot points, guys. Here's the thing. There really isn't another sell pivot. That's the only one. If you know pivot points the way I teach pivot points, so if you're a member of Bootcamp, you've done all of this, you know that sell, jam your stop at break even, and go for 121. It doesn't matter that you're at 137 when you're doing it. Huh? 1,500, 1,600 pips, that's okay. That's okay. Because you're going to be in it for a while. So if you got that down, it puts you in context in other types of positions that are not so big, so long, you know? So yeah. Sometimes I think you rinse your analysis so you start over every week and there's no continuity. And continuity equals sustainability. And so I'm trying to get you there, right? Now, Dakar says, I was bullish on USD Rand because of Quant-in-a-Box. Yeah, but you also need to understand that you're going to get crushed on your carry. So even though that's technically there and fundamentally there, it's still probably not a good trade. That's probably one of the most expensive trades you can possibly make. So yeah, just because it says it should go up, well, okay, if you're day trading it or scalping it, that's okay as well. But you got to be careful. I mean, fundamentals are only one part, right? Okay. All right. Once again, we went up. We hit our targets. And euro dollar is coming down in a blaze of glory. Now, like I just showed you on an annual pivot, I said this is the only sell. Well, that's the best selling pivot for the week and for the month. And we just got off last month's target. So the short-term target for bears is 109. The longer-term target for bears is much farther below. All of that says S&P 500 down. Oh, okay. Okay. Yeah. Okay. So, yeah. So you have an Islamic account maybe? Or more likely a lot of brokers, they would charge you the negative swap on both sides. So you're saying there's no swap or negative swap? So yeah, I guess if you have an Islamic account, right? But, and Islamic accounts don't pay or charge interest, okay? So, if you go like, yeah, but you're right, where if everyone else, let's say if the vast majority of the rest of the traders in that market only sell that pair and only take profit on that pair or only take a loss on that pair, but they never buy it, right? If no one ever buys it, then when it goes up, it's people getting out, but nobody's getting in. So yeah, you got to take that into account as well. But yeah, you want to sell the South African Rand because you believe its economy is in shambles. I don't think you're the first one to discover that. Well, Richard, you got to read into the fundamentals. So very often, an economy that is slowing will receive stimulus from the central bank. And what's the market trading? The slowing economy or the potential for stimulus? So you'll notice in fundamentals, you get to this situation a lot where good news is bad news and bad news is good news. But the economics are numbers. That's it. They're numbers. They don't lie. They're precise. But then now you have to read the human behavior. What is a human going to do about it? Okay. You paid money for pivot points? Join FX Bootcamp. I'll give them to you for free. I use daily pivots. I use weekly pivots. I use monthly pivots, and I use annual pivots. So this chart here has daily pivots pointed up, randomly. That's what these little ones are. Then I have weekly pivots, which are non-biased, and I have non-biased monthly pivots. So I have short, medium, and long-term levels of entry and exit. Well, then that was quite a while ago, huh? Yeah, that was quite a while ago. So you paid I got you. I see what you're saying. All right. So then you should have all of that. So daily or 4 hour. Well, A, I don't use 4 hour. B, daily, weekly, monthly, yearly. Huh? Oh, my pleasure. Yeah, my pleasure. Yeah, I was, MetaQuotes contacted me the same way that a wild dog with rabies would contact you. And so lawsuit on its way to the Wainster because they didn't like me. So, the way I look at it, if I'm providing tools and resources to support the MetaTrader platform, then I'm a good guy, right? They should contact me and thank me and say the tools that you're distributing are fantastic. It really promotes the use of the MetaTrader platform. Wayne, what you do is so good and so wonderful. We would like to sponsor you somehow. Like, why sell them for $5? Why don't we just pay you $5 every time somebody signs up and you can give them away for free? And, that's what it should be, right? Instead, they contacted me and they're like, what the beep are you doing? We're going to sue you. We're going to put you into the ground. Right? Oh, really? So they're just, whoever runs that company is probably from another world, like does not understand the concept of marketing anymore. Probably has a 1978 degree in marketing where you should hoard everything. You're like, dude, I'm on YouTube every day promoting your platform and you want to sue me. You don't want me to distribute tools that only work on your platform. Really? What a knucklehead, right? Like, seriously, right? What a knucklehead. So I'm like, okay. So they forced me to take the site down. All right. Well, good luck with good luck with surviving the industry. Good luck fighting TradingView, right? Good luck with that. It's so funny. But you know what? When you got people like that making those decisions, that's what puts them out of business. They don't understand the concept. They just really don't understand the concept. To say, this dude is on YouTube every day using our platform. He has really cool tools that he distributes for free. He's got a couple of custom indicators that are really cool. People love it. And he's selling them for $5. You're like, dude, this guy's cray. He's awesome. He's really doing us a service. He's marketing our product every single day and adding value to it. We should contact him. We should buy him lunch. We should do a YouTube special. Like, that's what they should be doing, right? No, shut them down. Okay. You do you. You do you. Yeah, seriously, right? Yeah. Yeah. Funny. Funny. All right. So anyways, one of the things we've been discussing a lot in the day trading group is setting up narratives. One of them is commodities. And so, like, if we're going to dip into this chart now, if you were going to try a continuation trade toward Kiwi dollar long, once again, what are you saying? Bitcoin up, oil up, S&P 500 up, okay? And if that is true and you get that right, then you are a buyer of the dip today. And if you're wrong on that, you'll lose some money. But that's why they use stop losses, right? Okay. Favor says Swiss yen. Okay. Why Swiss yen? Give me the narrative, Favor. Why would I, let's start with this, Favor. Why would I sell Japanese yen? Give me a bullet point. I don't need a dissertation. Give me one reason. Give me the why. Why would I sell yen? Ba 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 ba. Ba 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 ba. Hello. Ba 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 ba. Hello. Simple question. Let's go. Hello. Huh? All right. Well, forget it then. I don't believe that anybody feels the way I do. Bo, 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 bo. Do, do, do. Okay. Technical. No. I asked you why. Okay, so why sell the Japanese yen? So technical analysis of Kiwi, Swiss and yen stock. No. Why would I sell the Japanese yen? You're saying and the Swissy stock market. Nah, but you know what? That's still global macro. Do I even have Swissy stock market? I guess I probably do somewhere. Do I watch the Swiss stock market? I don't know. No. Spain. Is it this one? Swiss. I guess so. But you know, it's all macro, so I'm going to say no. I don't even want to look at that. So an answer that I was looking for, Favor, would typically be seasonality, but seasonality means you would be buying Japanese yen right now. So we have, you know, based on current analysis of the Bank of Japan's policy, stated policy, currently we would be selling Japanese yen because of a continuation of yield curve control. Now, maybe in the near future there's an adjustment, but they haven't. You hear that in the media, but I haven't heard them say it. So right now, if you were going to sell Japanese yen, you would tell me Yield curve control policy. Okay, fine. Okay, yield curve control. But the yield curve control policy is going against seasonality. So it's a bit of a wash, but I think I would lean more on what is actually happening, not what usually has happened. So I would lean on sell Japanese yen because of yield curve control. Okay, but now what? Now you're buying Swiss franc. Okay. Are you buying Swiss franc? Now, typically buying Swiss franc is a risk off play, not a risk on play. You don't say, I feel risky today, so I'm going to put money in the most conservative market on the planet. No. So usually if you're buying Swiss franc, because you would be selling Japanese yen, so you'd be buying Swiss franc. So I'm assuming up now. And you're saying, oh, the stock market's up. Okay, so that is a risk on play. What you're saying is you want risks. You want to invest in the stock market, but not the U.S. market, not the European market, not the U.K. market, not the Japanese, right? But instead the Swiss market, which is like not wrong, but it feels weak to me. Like that's the least aggressive when you're being aggressive, right? So I would say I wouldn't even look at that trade. And the way I look at it is the Swiss franc is typically a funding currency, and the yen is typically a funding currency. So they're both funding currencies, and they're typically both act the same as risk on and risk off. So if you were going to long Swiss yen, if it worked, and I'm not saying it wouldn't work, but if it worked, the probability of it being the best trade, I think, is quite low. So if it worked, I bet you pound yen went higher. I bet you euro yen might have gone higher. CAD yen might have gone higher. Aussie yen might have gone higher, right? Like, I doubt that out of all the yen pairs, the Swiss franc rallied the most. Because when it's strongest, yen is strongest. You see? And when things are awesome, Swissy is weak and yen is weak. So, you know, like, I don't know. I don't know. So I think you might find a good technical trade, and it probably is working beautifully. But remember, what we do as traders is it's relative. So you might make 100 pips on Swiss yen and feel really good. But if you'd done the same trade at the exact same time, like pound yen might be up 250 and you're only up a lousy 100. So you're like, hey, it's a good trade. Well, it's an okay trade. Okay. Santiago says yesterday was a risk off day. Why the change today toward risk on? No, I don't know if it's that. It felt to me like it was, I mean, we're kind of in between. That's what you're looking at, guys. We're in between. Really, we're in a range. But if you're stuck, Santiago, on a 15-minute chart, it's going to feel like it's up and down. You're like, this is high volatility, right? Like, it was way down for a while yesterday, then it came all the way back. So I'm talking about the S&P 500 in my mind. It was way red, and then it came all the way back right to where it was, and then a little bit of red again. If you back out, however, you're inside of a bigger range, and so we fell down to a range, and then now we're going back up to the higher part of the range. And from that point of view, you're like, well, nothing's really happening. We're just farting around in this range. But to someone on a smaller time frame, like a day trader, it's crazy volatility. What's going on? Well, there's just no trend. Well, flat is also relative. Like, is it really flat line flat, or is it like to a longer term trader, 100 pips down and 100 pips up? You wouldn't even notice it. You wouldn't even notice it. You're like, nothing happened. But if you're on a 15-minute chart, that's a big move down and a massive counter trend back the other way. So is it flat or is it volatile? Well, Einstein said, well, it's relative to your point of view. Einstein said it was relative to where you are in the space-time continuum. I would say it's relative to where you are in the price-time continuum. Are you on a daily chart or are you on a 5-minute chart? And it would be relative. So nothing happened on the daily chart. You're like, you would see a doji, let's say. You'd see a doji or a hanging man or something like that. You're like, oh man, nothing happened today. But if you're on a 5-minute chart, holy snap, what a day. Okay. So Lee says there's a divergence between price action and market action, right? So all of these things are just be cautionary. Because remember, the market doesn't agree, and the market may actually be wrong in certain situations. So like if you look at the Fed Watch tool that analyzes the position or pricing of bank-to-bank contracts in the money market, like 90% of the market is positioned in one way, and it's really strange because I think they're wrong. And I said this in a similar situation, I can't remember how long ago. Maybe you guys remember. Like it was about 4, 5, 6 months ago, somewhere like that. The market was nearly 100% positioned in a way that completely disagreed with everything I was saying every day. And it turned out I was right. Not that I'm brilliant. I'm good looking, but I'm not brilliant. But the best thing about me is my modesty. It was just, I disagreed with the market. That's all. I'm like, I don't know how they get to that conclusion. So I go through every day talking about how I get to my conclusion, and it turned out they ended up switching. And we might be in a situation like that. I don't know if we are, but that's the thing. Well, other institutional investors might be like that. And there's also bigger time frames going on, right? So you might be like, you're on your 5-minute chart and your 15-minute chart, and you're trying to figure out today, should you be a buyer or should you be a seller? I was talking to a hedge fund manager yesterday, and he's looking at things from 22-week outlook. It's just how it works. 22 weeks. He has to kind of have a point of view. And dude, you're like 22 weeks. It's just how it is, man. Don't ask me why. That's just the world. So 22 weeks. And you're trying to figure out today. They're trying to figure out the next 22 weeks. And that's why you get these divergences and stuff, because different points of view from different points of time for different rationale. So for one person, nothing happened. For the other person, it was wild and crazy. So the more you spend learning more angles of attack, probably the better off you are, because wouldn't it change your point of view if you thought the markets were, let's say, bearish to neutral? How would that help? Well, in rallies, you would have doubt, and bearishness to neutral, you would set up more bearish positions. And then when the market is bearish, you take longer positions, not bigger positions. So think about this. If it's heading up and you have doubts about it based on your fundamental analysis, your longer term view of everything, maybe it's seasonality, central bank, monetary policy, all of this is put together, right? And you decide, and that right there, by the way, is everything you need to do. What I just said. Then you decide. The day you wake up as a currency trader and you decide your long-term bias with rationale, your entire trading career will change in a positive way. Because then you make the decision, using technical analysis, everything looks up today. But but on the long run, you disagree with it. So you're like, well, I'm going to set my trades, let's say 50 pip stops, 100 pip limits. Then you go neutral, and then it turns bearish. Now you agree. You're like, okay, I really felt like this was coming. This makes sense to me fundamentally, and now it makes sense to me technically. So now I'm going to set my stops at -50 and my profit targets at 300. Is the technical entry this different? No. It's the same technical analysis. You're like, after the 21 crosses below the 55, I'm going to take the next 5/8 cross down. Good. That's the same thing you would do as a bull. See, as a bull, you said, after the 21.55 cross up, I'm going to take the next 5/8 cross up. I'm going to put a -50 stop and a +100 exit. Sweet. It's a nice little day trade. But once everything is pointed down and you're like, that's the one I believe in, you wait for the 21.55 cross down, you take the next 5/8 cross down, you drop a -50 stop and a +300 exit. Same technical analysis, same trigger entry, same moving averages, same charts, same idea. Everything is exactly the same, but you qualify now. You qualify the value of your alpha. You know it's going to fall further. So you're going for 300 versus going for 100. What's the difference? Congruency between technical analysis and fundamental analysis. So you got to get there is what I'm saying, right? So Santiago, you might see it in a different context of down day versus up day and all that kind of stuff. What? So look, here we go here. So you're like, why suddenly the big move up? What was the big thing? Well, we've hit a certain price on this pair. And if you are fundamentally bearish, you're going to take, like, let's say Fibonacci retracements down, and you're going this way. Okay, Santiago? Why was it so bearish and then suddenly a big pop out of nowhere? Well, there was also a potential for this. Yesterday, there was a potential for this, right? So in situations like this, this is where amateur retail traders get crushed. It looks like crazy undue volatility, like the market can't figure out where it's going. Well, the market can't figure out where it's going. You got to place your bets. But very often, retail traders don't stand their ground because they don't have an opinion. They're waiting for the sign. And unfortunately, there are gurus on YouTube that teach like, wait for the sign. Now everybody go. No, dude, no. You stand your ground based on your research and analysis. You're like knowledgeable. I want you to be knowledgeable. I don't want you to wait for the trick. There's no trick. So either of these were very, very, very likely to happen there. And when you're trying to both buy and sell, you will get slaughtered. So you're more like, what do you want to see as a trader? Okay. And then let's say you were a bear, I guess. You could wait for a Fibonacci retracement, and then on a smaller time frame than a daily, you wait for now your trigger. For me, I always use 5/8 crosses, right? Right out of my book. After a 21.55 cross down, wait for a rally up, take the 5/8 cross down, trigger, gone, snap, right? Drop a stop, take a walk. So you can say, you understand the green arrow is just as likely as the yellow arrow, but you're like, I'm going for yellow. Why? and you can give me 9 reasons why down is you feel is more likely than up. Cool. So now you know what you want to do before you've even done it. That's the secret. That's the secret. That is the secret. So I don't think this is going to work on this chart because this is. Let me change this chart now. We'll go simple. So you go to a smaller time frame, hourly, I guess. So we want to go. So this is a breakout low, and you're already a bear. Okay, you go peak to valley, and somewhere in there, this is what I teach. It's in the courses, it's in the book, all that kind of stuff. There's your likely sell zone. And then you look at it, you're like, I wonder how the market will react to this psychological level. And you sell. Now, somewhere in here is your sell, or on a 15-minute chart is your sell. Okay? But now you're thinking maybe somewhere around 78, if I get a bearish opportunity, I'll take it. And on this 15-minute chart now, you might have seen this drop, rally up, and that's your entry. Now, we're on a 15-minute chart now, but realize that you might be short 3 weeks. What's the difference of selling this for 3 weeks versus 3 hours? As far as an entry is concerned, nothing. But I would argue to you, having the ability to do proper analysis to determine whether you should be short 3 weeks or 3 hours or 3 days is your value creation. And the amount of effort on the chart is nothing. It's the exact same trade. But if every trade to you is exactly the same and you can't tell the difference between a 30 pip trade and a 300 pip trade, then I think that's what's limiting the success. Like, you might be a good trader, but you might not have the success that you expected. And you're like, what's wrong with me? Well, the worst thing is there's a couple of bad things. You can just start firing off a whole bunch more trades, and eventually what you do really well becomes weaker and weaker. And all of a sudden you're not a good trader anymore. Or you say, I only make 30 pips a trade, and I'm not making the money I expected, but I'm really good at those 30 pip trades. So I'm going to increase my lot size. I'm going to go from 1 mini lot to 1 standard lot. And then you will make the money that you expected, and then one day you blow up your account. Because you're over-leveraged. And over-leveraged is never the solution. Okay? So anywho, there you go. So now you look at this and you say, if that works, your first target is probably here. But I would even argue, if you're going to trade that type of trade, you're actually telling me something different. Not just down to support. What you're telling me is it's reversed. So that's different. Because if you're saying down to support, you're telling me it's range bound. You understand that concept? Do you think this is range bound? See, I don't know the future. It's your job to figure out what you think the future is. So you're like, well, Wayne, that doesn't look right like range. It looks like a lower high. Well, then what you're telling me is slightly different, that it's going to make a lower low. And we're probably actually aiming for more like this support. So you're selling at 78 off the psych level, 50% retracement, right? With the little 5/8 kicker. And and you're actually targeting, let's say conservatively 70 or 69, but as low as 66. Dude, we're at 78 on the FTSE. Dude, that's all the way to the October low. Oh God, if the S&P 500 did that, okay, that is big news that the stock market has peaked this year and is going to go test the old lows of October last year. What does that mean? That dollar's going to get ripper strong. Gold's coming down. Bitcoin's coming down. Oil will probably come down. Oh God, yen's probably going to get strong. Swissie's probably going to get strong. Okay, your rand is going to become worthless. Anyone that invested in South Africa is going to pull their money because they're trying to go to cash. Even if they believed in South Africa, they're like, dude, I'm getting crushed in my own economy. I need my money back. Okay? And you have a complete reversal of capital flows from deploying capital to hoarding capital. Much different world. And you're like, but Wayne, I was just trying to make 30 pips on this trade. Yeah. Well, you can have a much better narrative. And so you could, I'm not saying it's the right answer, but if you said that to me, then your value creation is higher than sell it for 3 hours. Okay. Luis says SPX is approaching its descending channel resistance and all that. Yeah. So about 8 or 9 days ago, I'm trying to get that accurate. I think about 8 or 9 days ago, I started repositioning my retirement portfolio. Yeah, I took profit on some profitable trades. And I got out of some losing trades. And I repositioned to be, well, like I'm telling you, I positioned it like my fund. So it would be less volatility. Okay, so that means if the S&P 500 goes all the way back to the lower lows, oh yeah, my portfolio will lose money. But the interesting thing about structuring it in a sort of a lower beta model is the S&P 500 might test October lows, but the amount of money I lose will not be that low. So I'm trying to flatten out the trough. I want a shallow trough. So let's say the S&P 500 drops 10%. I'll probably lose 6 or 7. You're like, well, Wayne, that's not that great. You still lost 6 or 7. Oh, I know, but relative. And then, of course, other higher volatility stuff, like maybe NASDAQ might lose 15%. S&P 500 loses 10, and I only lose 7. And I'm like, all right. But here's the thing. I'm also earning income. So I'll probably, let's say that process takes 6 months. In the 6 months, I'll earn about 6%. So I might actually, in total return, the S&P 500 might test its October lows. Let's say it's down 10%. I might actually be flat because I've already gotten paid money in my pocket, like a carry trade. That's all I'm actually doing is carry trading in the equity markets. And lowering my volatility, because carry trades, you want lower volatility. So I'll have a shallow trough, but still have a consistent income. But I also believe in 5 years the stock market will not be this low. Things will improve, and my net asset value will be positive again. So all that drawdown was sort of an illusion. It's a paper loss followed by later on a paper win. So nothing actually happened, except I'm collecting my carry, right? And the cool thing about the fund that I'm developing, and I'm having fun with this, like if you buy dividend stocks, you get paid quarterly or every 6 months. I'm building one that pays every month. like a paycheck. Because that's how I see it. I want to help people retire. So every single month, I send you a check that you can live on. I like that idea. I love that idea. You're like, wait, what? You get paid monthly? Uh-huh. So anyways, so that's how I look at all of this. So descending channel resistance. Well, I repositioned myself. So if that happens, Luis, it won't be incredibly painful. I'm exposed to the risk, but less so. Right? And if it's a tolerable retest of the low and then we bounce back up from there, it'll actually kind of be irrelevant. So cool. Now, if it makes lower lows and we're dropping another 30%, I'm not going to enjoy that, but I'm still going to earn income. So anyways, whatever. Whatever, it's only money. Right? It's only money. So I hope you guys get a retirement account as early and young as possible. Okay? So if, let's say you're 35 and you just start. Okay? You're 35, so in your first 10 years, you get your first job, but you got school loans to pay for. So all your extra capital goes to pay your student loans. And then you get married and you use some money for that. And you got to get your first house. And so you're really a slow start. And you don't even start saving for retirement until you're 35. Okay? Great. And so you put in $1,400 a month. Okay, when you're 35. When you're 65, actually when you're 60 is the calculation. So for 30 years, I guess that's 65. Okay, 30 years later, you will have 1.8 million. Now, if your company matches, you'll have over $2 million, probably a lot more than 2 million. Let's say 2.5 million if your company matches. So you work for the same company and you're putting $1,400 a month aside and they match. You're going to be at $2.5 million. See, a lot of people will say, well, I can't save $1,400 a month. And then you find out they're spending something like $1,000 a month on their car lease. I'm like, do you understand that that's well over $1 million? And they're like, wait, what? Yeah, that's probably $1.2 million you gave up so that you can drive a nice car. They're like, it's only an $80,000 car. Yeah, but you paid $1.2 million. Idiot. Because you could have just put that in your retirement account and sat on it for 30 years and had 1.2 million. But no, when you were 35, you drove a nice car to impress your buddies at work. Yeah, good job. Good job, bro. So, yeah, isn't that interesting? Compound interest. $1,400 a month. That's the kind of money you get. If you are a company like me, your trading company, your Forex company. So you start a Forex company, and when you get to about, I think it works out to like, if you're making $300,000 a year in your Forex trading company, once you get to that threshold, kind of all the numbers start to change differently. But anyways, you will be able to put aside more than $50,000 a year. Okay, so of your 300, before you pay taxes, before you pay yourself, before you do anything. Okay, so it's somewhere around $3,000 or $4,000 a month. Let's say it's $4,000 a month. Well, the other example I just gave you was 1,400 because that's where you max out. So imagine this. You're 35 and you're making 300K as a Forex trader. Before you pay the tax man, it's like you never touched this 50 grand. It goes into your retirement account. And when you retire, oh my God, it's 4 million or more. And just on the money you didn't pay taxes on. Now you pay taxes when you take it out, but who cares at that point? It's well, you can't say guaranteed, but you have to understand if you want to become a multi-millionaire, it's straightforward and, dare I say, easy. It's just slow and steady. So I would recommend you get going as quickly as possible. As soon as possible. Okay? And if you can't do it, I'll do it for you. Just hook up your retirement account when I got my thing going. Okay? Sounds weird, right? But then you do you, and while you're doing you, I'll do you. You do you and I'll do you. You'll get done. Oh, that's so crazy weird. Yeah. How funny, huh? Right on, sniper. Yeah. So anyways, cool. So do you think FTSE is going to fall? Do you think S&P 500 is going to fall? Do you think this Euro 50 is going to fall? Do you think NASI is going to fall? Do you understand, like, your point, your role in the marketplace is to understand the forces that would make that true or not true. Is it going to fall or is it not going to fall? And once you've decided on that, everything else will click into place. You will have rhyme and reason for Bitcoin to go up or down, for oil to go up and down, for gold to go up and down, for dollar to go up and down, for yen to go up and down. Meanwhile, the old you as a trader would just like randomly go through 100 charts and you're like, oh my God, buy the moving average. No, buy the moving average in the right context, but you should also know when that whole move is going to collapse. But so, like, I will say statistically speaking, no retail traders set things up like that. They just go find trades. And I know you all agree with me that we've all tried it and you do not get consistent results. So the reason is you're not trading consistently. So you will not get consistent results. Right? So snipers like agree. We all need to get there emotionally, not just intellectually. And that's why it's important, like snipers types in a chat room in front of a lot of people that sniper agrees. Yes, we've discovered through trial and error, which is randomness, that you do not get consistent results. In particular, in a market like the financial markets. Do you, like at Oxford, when I was doing that program and my professors are astrophysicists, do you know why they went from studying galaxies to studying the financial markets? The financial markets made the study of galaxies, the the mathematical study of galaxies, look boring. They're like, oh God, if I have to measure this black hole one more frickin' time, I'm going to jump in it. But the financial markets, oh my gosh, that is so complicated as a data set. It's amazing mathematics. And the study of galaxies is boring. So, how could you be random in a data set like the global financial markets and have consistent results? You just can't. So the only way you can do it is consistently trade consistently. And so you come and you say through your careful analysis, I don't care how you get there, your study of black holes in galaxies around the universe, you say, sell the S&P 500. Good, sweet, nice, high five, snap. That's your point of view. Do I know if you're right or wrong? Well, I don't know the future. I don't know. No, I don't know. It depends for how long. For the next 10 years? Probably not. For the next 10 months? Yeah, very much could be. So what would a bear do here? Sell the lower high, 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 sell the lower high. That's called consistency. Okay? How about this? Have I ever recommended anywhere, like my book or in the training courses, to sell the higher high, 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 sell the higher high? No, not even once. So what is that? So if it's rising, you are consistently not selling it. But you're like, you believe it's going to fall. Well, okay, well, maybe if it's doing that, maybe around here. So now you just wait and wait and wait and wait until what? Lower low, sell the lower high, sell the lower high. And all of a sudden you're consistently selling lower highs and consistently waiting on the sidelines for market conditions to change if it's making higher highs. Now you are consistent and your results will be consistent. But if you're selling this yesterday and buying it today and then maybe selling it tomorrow, I don't know. How do you decide if you're going to sell it tomorrow or buy it tomorrow? Well, you're going to start doing things after things occur and you're going to get caught in the middle and you're not going to get out at the top and you're not going to get out and you're not getting in the bottom. So you're going to get in the middle, you're going to get out of the middle. And if you're really, really good after doing that 1,000 times, you will probably be flat broke. So imagine, let's say you traded every single day for a year and you find yourself, you're basically flat broke. You worked a year, but you didn't really lose money, but you didn't really make money. The difference is you haven't picked a team in your trading. Now, here's the paradox that you will find. And I've done the math and I've studied my own trading, and there are many, 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 many paradoxes, some of which I found in the early days and I put in my book. But one of the paradoxes is you could spend a year trading both ways, and it's because you end up looking for rationale. Like after it's reversed, then you start trading, but now you're in the middle, and then you don't know when to get out because obviously you don't know when to get in. So you'll get out in the middle. And so after 2,000 trades over the course of 365 days, you have no profit. You haven't lost any money, don't have any profit. Okay? Now here's the weird thing. Then you change, not the techniques for trading, but you simply only trade in the direction of a bias. So you're bullish only or you're bearish only. So at the end of the year, you might have 1,500 trades, not 2,000 or 2,500, whatever the number. So you'll have significantly less trades, but significantly more profit. because you were never tripping over your own toes. And because you're only a bull or you're only a bear, you're anticipating the moves earlier, you're preparing the trades earlier, you're in the trade earlier, but you also know when to take profit because all of that's clearly defined too. If you don't know that, then once again, you don't know technical analysis. I'm assuming you know all of this stuff. So you will be better able to read market conditions, prepare for your trades days in advance, certainly hours, and then you're going to see the earlier triggers, so you're not buying your first bullish trade in the middle of the move. You're going to be closer to the beginning of the move, and you'll have enough profit where it'll be worth it to get out of the trade at conservative levels of resistance, right? And all of a sudden, it's like you're doing the same type of trading, but you'll get way better results. And the paradox is with less trades. But the trades you're doing are consistent and consistently better quality trades because the trade plans are developed in advance. You're not reactionary going, I guess I'm a bear now. Okay. 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 So, but you'll have to, 99% of you will ignore me, and 1% of you will slowly change. Okay. 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 So you either get the up and then you sell, or you get the down and you sell. But the next one wouldn't be today, probably. Sniper says in most rangy markets, breakouts fail, right? Well, I say it differently. I don't like sort of the language of fail. I know what you mean, and I'm not picking on you, but I don't use the word fail because it's a negative connotation. So instead of me giving you rules like these fail and stuff, I try to use language or imagery or a story or something that we can grab onto. And what I say to people, and you'll recognize this because I've done this on purpose, okay? Sideways moving markets will continue moving sideways forever and ever 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 and ever. What's the last part, guys? There's one last part to that. A range-bound market will move sideways forever and ever 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 and ever. Close, Alton. Not exact. Yes, you did. You did. I'm being very, very nitpicky, Sniper. Does anyone? Nobody? Oh, wow. See, bad coach, huh? Well, it's not. You guys are close. It's not precise. Thank you, Ashish. Until it breaks. Because the break part is also important. Until it doesn't, then it's like until. What do you mean doesn't? Like you know, like there's a missing. what would it until it doesn't what? Okay, and so in this case, what we're looking as for a break, and then you're like, oh, and then you do a breakout trade. Yes. So I have it marked here from a long time ago. So let me just kind of refresh this because we're missing a piece. Okay, so I did this a long time ago. And we thought it could go from M3 to M1. Oh my God, it did. Now, look, everyone's forgotten all of that. And someone might argue that, no, it's still a lot of downside risk to this, right? So what you do is it moves sideways. And of course, you can adjust what you see as the range. I drew those a million years ago, so I can adjust them. But the logic is, if you believe there's bearishness, you sell at the top and you take profit at the bottom. And then at some point, it'll break, pull back, okay? And after a break, now it's a trend. So the reason it's important to say until it breaks is because it also connotates that now that it is broken, you set up a trend trade. That's why the language is important. Okay? So you buy here, you exit here. Sorry, you sell there, you exit there. You sell here, 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 you exit there. Oh, snap, it kept going. No way, that's so interesting. Sell here. Okay? Sure what I'm talking about? And when we were here, like I said, just 9 days ago or something, like that's about right. I was taking profit on companies that are in my retirement portfolio and moving it into a more conservative investment strategy because of to me, the great potential downside risk. So I've already played all of this. Okay? I sold stock at the top, not short sold. I took profit. And now I'm in a more conservative risk, assuming that this at minimum is possible and then this is plausible. Cool. Well, that's portfolio management, right? Now, one thing we talked about in the day trading group last night is I was reading John Maynard Keynes' paper from 1924. And in the paper, he writes about the manipulation of the money supply by central banks and how it's a really bad idea and that they shouldn't do it. And back then, the Fed wasn't created yet, so it had to do with the Bank of England. So he wrote this paper directly to the Bank of England. He said, stop messing with money supply. It's only going to lead to inflation. Then banks are going to struggle to maintain their books. Then you'll go into a banking crisis. Then credit will tighten. And then in a certain number of months, a recession will follow. And he just described exactly what we're going through today. Okay? Not just the Central Bank of the United States, but the central government of the United States, each pumped out $5 trillion. They manipulated the money supply. Now, really, the Fed didn't manipulate the money supply. They created credit. Kind of the same thing, but in many ways, very significantly different. So let's not count the Fed. Let's just count the central government. Congress, the Senate, and the President of the United States decided to give $5 trillion to the American public for free. They did it by borrowing money, and that directly increased the money supply. And that directly created inflation. And in fact, John Maynard Keynes in 1924 and Milton Friedman in like 1965, they wrote, and many other economists studied this and wrote the same conclusions. The only way to create inflation is through manipulation of the money supply. So they gave a bunch of money away for free. None of the money had a return on investment. It was non-productive. If there's no return on investment, but you increase the money supply, guess what? The value per dollar falls. That's what inflation means. We had more money, but the same value of the economy stayed the same value. We had the same amount of assets. We did not increase productivity. We didn't create more assets. All we had was more money. So the value of every dollar in America fell because we added $5 trillion to the money supply. Well, John Maynard Keynes in 1924 was writing to the Bank of England, and they're like, this is a really bad idea. If you want to positively impact the economy, you impact demand. And that's kind of like what the Fed did with creating credit. You're creating demand. And the government can create demand by investing public money or borrowing money to create into public projects because there's a return on investment. So if you were building schools, if you were building post offices, if you were building railroads, if you were building bridges, if you were building airports, if you were building nuclear power plants, if you were building windmills, okay, if you're making small business loans, all these things, what you get is a return on the investment. You get a bridge, you get a road, you get a railroad, you get an airport, you get a port, you get, your nuclear power plants, you get a thriving small businesses that hire people, and you get a return on investment. So that's what John Maynard Keynes is famous for, is the idea that the government steps in, runs a deficit when there's a recession, but creates demand with the money. And then when times are good, you're supposed to raise taxes and pay down the deficit. Of course, we've never done that, but that's what John Maynard Keynes said in the 20s. And so now here we are, we hit COVID, and the only thing that happened was the government pumped $5 trillion into the money supply, okay, and creating demand without return on investment. So all they did was increase the money supply. Oh, you don't have money to pay your rent? Here's some money. We just created it. We just borrowed it from Germany. So here's money we borrowed from Germany. Go pay your rent. It's free money. Don't worry about it. Well, very unproductive, no return on investment type money. So all you did was increase the money supply, right? That's all you did. So every dollar in America is now worth less, which means you need more dollars to buy things. That's inflation. So anyways, it was great because reading the paper, he outlined, there's a whole chapter on his advice to the Bank of England on how to do things better. Of course, the 4 chapters before that are all about the different negative impacts on society. And of course, one of them is going to be rampant inflation. Sweet. Isn't that interesting? It's all been outlined. It's all been studied. We know all the problems and we know all the fixes. And yet, we did it and we're not doing anything about it. It's really amazing. It's always and everywhere a monetary phenomenon. It is. It truly is. And it's just amazing that we did it. But I understand a zombie apocalypse was necessary. It was the end of the world. So, I get it. People say, well, We got to do whatever it takes. Okay? And then if we save the world, then we'll figure it out. We'll dig ourselves out of the hole. We're not digging ourselves out of the hole, and we're not fixing it. So, unfortunately, think of it, until it breaks. Well, that's the issue. The economy, and again, this is fiscal. So Congress, the Senate, and the president, they have to decide to have a controlled fire to prevent an out-of-control forest fire. You have to have a controlled burn. Nobody wants their land to be burned, so the government's going to have to put on their big girl panties and decide whose land is going to be burned, and then burn it. And you have to be strategic. You can't just burn like, well, we'll burn 1/10 of an acre everywhere. No, most of that would be worthless. So you got to know, like, where is the fire? What direction is the wind blowing? And you got to get in front of the fire. You see what I mean? And you have a small controlled burn, and you burn 10,000 acres to save 5 million acres. Remember Jay Powell when Senator Warren said, you're going to put 2 million people out of work. And he said, yeah, well, 360 million Americans are facing high inflation. That was killer. You, sir, are designing a program to put 2 million Americans out of work. Yes, well, 360 million Americans face high inflation. Controlled burn. Now, the other way to stop, right? The other way to handle this is let the forest fire turn into complete, out of control forest fire. Unbelievably hot. The wind is blowing. Everything is dry. And it just burns through the forest until it naturally just dies on its own. Well, in America, we call that depression. And I'm not saying we're going into depression, but I'm saying the government is the cause of this fire, and they're not even considering a controlled burn. See, if you burn the 10,000 acres in front of the forest fire, when it gets to the burned area, there's no more fuel, and the forest fire just dies out. So you burn 10,000 acres to save millions of acres by getting out in front of it before it's out of control. So the only way out of this is we need $5 trillion to be destroyed. The thing is, will the fire put itself out after $5 trillion if nobody's in control of this? Or do we destroy $8 trillion worth of value? That's $8 trillion of housing prices, $8 trillion of retirement accounts. That's $8 trillion of everything, huh? No, but Alton, I don't think Volcker is the answer. I think the Fed's way late, of course, and then had to go way too fast. Like, all of those are mistakes. But I think you could jack interest rates up to 10% like Volcker and just kill everything. I think there's a way out of it. It doesn't need to happen. What we need is leadership in the federal government. And the leadership says, we raise taxes for the next 10 years. It's a tax. And over the next 10 years, we will raise through taxation, temporary, in law, temporary. We will raise $5 trillion in taxes. When we raise the $5 trillion, the tax will go away. This is just to pay back the COVID money. So, the federal government, which is Congress, the Senate, and the President of the United States, They pass a law to temporarily raise taxes over 10 years to gather $5 trillion, and every single penny, by law, has to go 100% to paying down the debt. Milton Friedman said this. John Maynard Keynes said this. This is not new. The inflation comes from that scenario of the government gave money away and it's non-productive and they increased the money supply. So when the government raises taxes, they take money out of supply because you have to give up your money. Whether it's you as a person or a company as an entity, whatever, the money goes away from those bank vaults, pays back to foreigners, and the money is gone forever now. It's out of the money supply. Goodbye, money. And your inflation goes away. Permanently. That's putting out, that's the burning 10,000 acres. Who's going to pay these taxes? Well, it's going to be rich people and businesses, of course. We all know that answer. And maybe those people don't like it, but whatever. It's the only way out. Or we have an out of control, because we can do that precisely. We can collect $5 trillion in taxes to the penny and then stop. But if we just have an out of control wildfire, how far will the stock market fall? 10% or 70%? We don't know. Nobody's in control. Nobody's doing anything about the problem. Are banks going to fail? Is your house going to drop by 50%? Oh, you're going to retire and your retirement account's going to drop 70%? Well, how are you going to live there? Take equity out of your house? No, your house just dropped by 50%. You know, and all of a sudden dude, that's scary. We need adults, right, in our federal government, don't we? To prevent that scenario? Wayne, what's the duration it takes for fundamentals to play out? Well, you know what? I spent hours reading John Maynard Keynes' paper from 1924 to the Bank of England, and it actually answers that question. Right? So I could tell you, of course. Now, I told everybody in the day trading group last night, but I don't know how much are my 2 hours I spent reading that. How much is that worth? I'll tell you, I did the work. So find the paper and spend hours reading it. It's in there. Read Milton Friedman's books. It's all there. It's all out there. These are not my opinions. This is the previous research. So I can tell you, but I don't know. I'm pissy now, so I'm not going to. But I'm just saying, none of this is new. None of this is new. It's interesting, though, isn't it? So I think I'll leave you to it. The stock market's open, and it's going to be a fabulously interesting day. Now, on a more serious note, day traders and swing traders. Okay, day traders and swing traders have the stop, look, and correct session at 2. I hope you have a lot of fun. Then at 4, I do my day trading group. I'm not going to do the day trading group today. There's an almost certain chance that there's a slight chance that I don't, but there's a high probability I will have to put my dog down today. So I have to take her. She's got a one-way ticket to paradise this afternoon. So I probably won't be around at 4 o'clock. Okay? Just so you know, so no day trading group today is what I'm trying to say in English. Okay? So we'll leave it at that. So peace on earth. May the pips be with you. May your profits be above average. And I will see you when I see you. Yeah. Yeah, it's she's over 16 years old. Yeah. It's time. It's time. The hard part, and I say almost, like, she had a good morning. We went for a big long walk this morning. She hasn't been able to for a few weeks, and now today she wants the big walk. And last night I gave her the bone from my tomahawk steak. So a bone the size of her body. She chewed on that last night and everything, but today she seemed chipper and she didn't have any problems in the middle of the night, although we had to take her out only 2 or 3 times. So it's, but when it's time, I suppose. So it's hard. Yeah. 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 So thank you, everybody. I'll see you soon. Thank you for your patience and your understanding. Have a wonderful day.